Hello everybody, a very happy day to all of you and welcome to my YouTube channel. In today's model, we're going to take a specific look about bond yields. Mahesh, a subscriber to my YouTube channel, had posted on the YouTube page what are bonds and how to calculate a bond's yield. Thank you so much, Mahesh. Because of you and your question, I could make this presentation on understanding the calculations regarding a bond's yield. What are bonds? Bonds are marketable debt securities. Marketable implies that they can be traded. The ownership of the bond can be exchanged from the seller to the buyer on conclusion of a sale trade. Unlike a fixed deposit with a bank, which is not marketable, bonds can be traded. There is a primary market in which bonds are issued. There's a secondary market where mutual funds, banks, as well as other financial institutions trade the bonds amongst themselves. Bonds are also called as fixed income securities because everything about them is fixed. In this context, the implication of the term fixed means it is predetermined. Okay? So fixed income securities means everything about the bond. These include the issue price, the coupon payment date, the coupon reference, the repayment date, the repayment amount. Everything is known to the investor before they invest their money into the bond. And therefore, the implication of the term fixed over here is it is predetermined. Bonds have the following characteristics. The first one is the par value. Par value is also called as the nominal value of the bond. In some countries, it's called as face value, but all the three of them are interchangeably used and they imply the same thing. The bond issue price is the price at which the bond is issued in the primary market. In most of the cases, the bond issue price is equal to the par value. In some cases, the bonds can be issued at a price lesser than the face value or the par value. These are called as discount bonds because the issue price is at a discount to the par value. Very, very rare you would find instances where bonds are issued at a premium to the par value. So the issue price of the bond is the key determinant of the valuation of the bond in the secondary markets. A bond coupon is a percentage of the par value. Remember this, irrespective of what is the issue price or the traded price, companies will always announce coupons only as a percentage of the par value. Fixed rate bonds have a fixed rate of coupon. By fixed rate of coupon, we imply that throughout the life of the bond, the issuer will pay a fixed rate of coupon to the investor. On the other hand, we also have floating rate bonds. Floating rate bonds are those bonds that have a coupon that is linked to an underlying index. That means if there are any changes in the underlying index between two coupon payment dates, the next coupon payment will be different compared to the earlier coupon payment. Therefore, floating rate bonds are benchmarked to an underlying index. Bond coupon dates are predetermined and are mentioned on the bond. Nowadays, bonds are no longer issued in a physical format. Like equities, they are issued in a dematerialized format and all the details of the product are stored with the depository. The factors that determine the bond coupon rates are as follows. The first one is the creditworthiness of the borrower. The borrower is the issuer of the bond, and therefore, if the creditworthiness is very high, as determined by the credit ratings, then the borrower gets to pay lesser coupon compared to the less creditworthy borrower. Maturity of the instrument is the second factor. That is, longer term instruments have a higher coupon compared to a shorter term instrument. Is the bond providing collateral? Is it a secured bond or an unsecured bond? If it is a secured bond, then coupon is lesser compared to an unsecured bond. But overriding all these factors is the macroeconomic rates, which are determined by the RBI. I've already uploaded a video on repo rate, reverse repo rate, bank rate, and MSF rates, the link of which is shared in the comments below. A fixed rate coupon, let's take an example. A $100 par bond pays fixed rate of interest at 8% for 5 years. If we take a table which maps out the cash flows every year, in year 1, the investor earns $8, that is 8% of 100, and every year he earns $8 for holding on to the bond. In the 5th year, the investor also gets back the par value. Therefore, in year 5, they will get back the par value of the principal invested, that is 100, plus the coupon for that year, 8, 108, is the cash flow for the investor in the 5th year. Now we take a look at yield calculations. Remember these yield calculations because this is the same yield calculations we will be doing for bonds, equities, margin accounts, etc. The coupon rate is the cost of borrowing. Yield is the return to the investor. Okay, this is a very important thing to remember, that whatever is the cost of borrowing is a cost to the issuer, to the borrower. Therefore, that is predetermined. That is ascertained at the time of issuance of the bond. But yield is a return to the investor. And that return can vary from investor to investor on the very same bonds. The bond issuer's interest cost is predetermined. The bond yield depends on the price at which the investor buys the bond. So, coupon and yield are related to each other but do not mean the same thing at all. Let's work this out. Let's say there is a bond which has a par value of 100. The coupon rate is 8%, and Mahesh bought this bond in the secondary market at 120. He has paid a premium for it. The coupon that Mahesh received is 8, that is 8% of 100, and the yield to Mahesh is, how much has Mahesh earned? 8. How much has he invested to earn that much? 120. So 8 divided by 120 gives an yield of 6.67% to Mahesh. Let's look at it again. The yield calculation is coupon earned divided by the purchase price. How much is the coupon they have earned? 8. What is the purchase price? 120. So 8 divided by 120 is the yield to the investor. Did you notice something? When Mahesh bought the bond at 120, the market price at which he has bought the bond is higher than the par value. The yield is therefore 6.67%, which is lower than the coupon. Bond investing rule number 1. If purchase price is greater than face value, then yield is lesser than coupon. Okay? So if the purchase price is higher than the face value, the yield is lesser than the coupon. Let's work out another example. Keeping the bond par at 100 and the coupon at 8%, Mahesh bought the same bond at 80 rupees or $80. Therefore, how much coupon will he receive? 8. So whether Mahesh bought the bond at 100 and 20 or at 100 or at 80, the coupon amount that they get is that he will get is fixed, which is 8. So this coupon is 8. What is the yield to Mahesh? How much has Mahesh earned? 8. How much has Mahesh invested? 80. So 8 divided by 80 gives an yield of 10%. This is the yield calculations for Mahesh, who's bought this bond at a price that is lower than the par value. Did you notice something? When Mahesh bought the bond at 80, the price is lower than the par value. The yield is 10%. Bond investing rule number 2. If purchase price is less than face value, then the yield will be higher than the coupon. So over here the purchase price is 80, the face value was 100, then yield is 10%, which is greater than the coupon of 8%. This is the most important relationship in bond investing. That is, bond yields have an inverse relationship with bond prices. If bond prices increase, bond yields fall. If bond prices decrease, bond yields increase. A high yielding bond is not necessarily a good investment because the bond yield is high because the price is low. Why is the price low? Multiple factors that can cause the price to be low. So, this is the number one rule of bond investing, that is, bond prices and bond yields are inversely related to each other. If you have any queries, please post in the comment box. Because of Mahesh, who posted in the comment box, I got to make this presentation. So, if you have any topics that you would like me to cover, do post your suggestions in the comments again. Your feedback is very important to my team so that we can share more such videos on simplifying finance, making it easy for you to understand. Thank you so much for watching the video and looking forward to meeting you all again for the next video. Thank you so much.